So my name is Greg Brogger. I was the founder of SharesPost in 2009, and as a result of a joint venture that SharesPost did with the NASDAQ OMX group, I'm now the president of this soon-to-launch platform called the NASDAQ Private Market. And one of the questions that we frequently get is, what problem is the NASDAQ Private Market looking to solve? And in particular, when we're in Europe, how does that relate to European private growth companies? And so back in about 2009, we started to see some, well, trends that had been underway for some number of years. And in short, private companies are staying private much longer, and there's a bunch of different reasons for that. These changes are structural in the capital markets. And essentially what's happened is the threshold between the private and public markets has moved significantly. So if you went back to, say, kind of the 1999 time frame, or let's use the slide I actually brought, 91 to 2000, you would see 330 IPOs. Now, skip forward a decade later, and you're looking at 119 IPOs. And this has been, as many of you know, a pretty banner year for IPOs, but I think that number is probably not significantly greater. And the other trend that you see in the market is that the size of the companies that are going public is, on average, much larger. And the size, I should say, yeah, the size of the companies is larger, and the amount of capital raised is much larger. And that's for a bunch of different reasons. People point to the regulatory burden on public companies, so Sarbanes-Oxley in the US. People talk about decimalization and how that's changed the incentives, the profits or profit opportunities of investment banks in trading equities has significantly dropped. People talk about sub-penny per share trading commissions for these large investment banks. And what that means is, unless you're a very large company with a very large float of frequently traded shares, you don't represent much of a profit opportunity to them. So there's a very large number of public companies that no longer have the support of investment banks or analyst support, and so they have all the burden of being public, but relatively little of the benefit because they remain largely illiquid. So besides those structural changes, one of the things that we started to notice right around, and obviously these are just sort of high-profile examples, but right about the time that Google was going through its kind of first hyper-growth phase as a private company, it seemed like the paradigm shifted amongst founders. It used to be that the IPO was the end-all, be-all, the destination to which everybody who was starting a private growth company aspired, and they wanted to get there as soon as possible. But with Google, people started to notice that they were staying private, or they were avoiding the IPO as long as possible, and it was only as a result of US securities laws, this Section 12G that said at the time, it's now been changed, but at the time, if you have more than 500 shareholders, then you essentially have to go public. And then the much more frequent update there is, of course, Facebook, also looking to extend its runway as a private company as long as possible, and then even some very large public companies wanting to get back into the private space. And that desire of founders to stay private longer is not surprising, because you can imagine a company in a period of hypergrowth thinking about standing in front of Wall Street and beyond, talking about quarterly earning projections and how difficult that can be if you're going through hypergrowth, and how much of a price you pay in the public markets if you miss those earnings. And so I think maybe the dominant strategy even amongst the most successful founders is to keep the company as private as long as possible, or certainly until you have some amount of stability and reliability in your earnings and your business model. And so with that in mind, let's compare kind of the growth company or life cycle of a growth company from that first period, the 1999 period. And you can see that at that time it was on average in year 4 that a company could go public. And so that meant by the time it had any real need for raising capital scalably, $50, $100 million or more, or before it had a real need for shareholder liquidity, it was already able to transition into the public markets. And the public markets are quite effective, right? You have all, over many decades, you have this ecosystem that is built up to enable companies to relatively easily raise capital to create liquidity for shareholders. But if you then skip forward, I'm going to come back to it. Oh, there we go. That's some high technology graphics presentation there. If you skip forward to where we are now, the company's trajectory, its growth is still the same. But no longer can they go public in year 4. Now it's something like 10, 11, or 12. And that creates what we call the sort of capital markets no man's land. So if you are an 8-year-old, $500 million market cap company, you're still too small to get here, but you've outgrown the ecosystem here. So that's why we started SharesPost, and that's why NASDAQ, as they looked at these changes in the marketplace, said, how do we support entrepreneurs? How do we support innovation given this structural change? And what they decided to do was follow their clients and support them into the private world. And that's what the NASDAQ private market is designed to be. I will now back up and take a look at this. Just a sort of another, anecdotal insight into how suddenly this change is happening. So there was an article in the New York Times, and this is just from January of this year, and it was this fairly, or much talked about story when they published the fact that there's probably between $25 and $40 billion plus market cap private venture-backed companies. And that had previously been sort of unheard of, because well before getting to $1 billion, of course, founders, boards, VCs would be taking their companies public, but not so. And then what I find also very interesting is that most of the VCs that are, in a sense, closest to what private companies are choosing to do are saying this is not changing, this is only accelerating. So within a year, and we're halfway there, and I think this number has probably already been exceeded, one of the partners at Sequoia was saying, look, just looking at our portfolio, we know that there's going to be more than 100 billion-dollar-plus market cap companies, and it represents a permanent change. This is the strategy that founders want to take. And you can look at Twitter, and you can look at any number of other companies in Europe and US and other places. This is, oh, we get to see it again. This is what the future, or the foreseeable future at least, looks like. So why is that a problem? Why is that capital markets no man's land really a problem that we should think that we need to do something about? And it kind of ripples through the entire ecosystem. So the angel community, which is a very prominent and very important part of the life cycle of growth companies in Silicon Valley, has a significant problem, because they have a viable business. They have a viable investment opportunity to the extent that they can invest it at a seed stage, and then at year 4 they can sell if that company went public, because then they can recycle their cash into the next startup. But if you have a 10 to 12-year investment horizon, that's unworkable, at least for these individual sorts of investors. Employees sit with the bulk of their net worth sitting in stock options that they can't liquidate. And if the idea behind stock options is to incentivize employees, and in part to get them to take less salary today because their options are going to be worth something tomorrow, most individuals, like angels, are not set up with a 10 to 12-year investment horizon. So that really undermines the notion of equity-based compensation. VCs, and this is sort of the problem can cut both ways for VCs. In the States, it's hard to know exactly how the numbers will shake out, but as a result of kind of the financial crisis 2007 and on, there's been significant call it consolidation, and maybe that's too kind of word. There's just been a lot of VCs going out of business, because when they go back to their LPs to raise new capital for the next fund, they can't show returns on many of even their successful portfolio companies because there's no liquidity for those positions. And so they would potentially benefit greatly from being able to harvest capital sooner. At the same time, many of the VCs we talk to also say they have the exhausted founder problem, which is they've got a company maybe that's 8 years old. It's done very well, and there's some milestone that might take them 2 years to get to, which will see a substantial increase in the value of the company. And the founder comes to the VC and says, look, I just need to sell the company because it's been 8 years, and I just, for whatever personal reason, family reason, investment reason, I'd rather sell today at a suboptimal valuation than keep going in the future. Non-VCs, it's like every player in the ecosystem has a problem with this. So if you looked at, and I'm using a kind of a US-centric view of things, but if you thought about the larger fund complexes in the US or institutional sort of or mutual fund type investors that are used to returning, I think, sort of the long-term capital, at least when I was in business school, what they used to talk about was a 12% long-term return on equities. And we've seen over the last decade, obviously, it's been just a mere fraction of that. And different people see the data different ways, but it seems like, in light of this trend, growth companies want to stay private. And if growth companies are not in the public markets, then public markets don't have growth type returns to balance the slower growth larger companies. So the small cap companies that would be driving these larger aggregated equity returns aren't in those markets anymore. And so that creates large problems for some of these larger institutional investors. And they start to look into the private market to find those same sorts of growth engines they used to find in the public market. And then lastly, private companies, the best private companies will always be able to raise capital. If they're successful, the people that are the earlier investors will always find a way to get them, write them a check to fund that next stage of the company's growth. But it becomes a cost of capital question. So it may be, in years 1, 2, 3, 4, 5, something like that, a founder, even a good founder, might really, benefit from a high-quality venture capitalist that maybe acts as something of a mentor or brings relationships or strategic partnerships. But by year 6, 7, or 8, particularly for a successful company, the business model has matured. They don't need a mentor at that point anymore. They don't want to go through the headache of another kind of venture capital type round where they have to reorganize the liquidation preference stack, right? At that point, they just want money. They want low cost of capital as simply as possible in the largest amounts as possible and the best terms as possible. And for all of their benefits and skills and strengths, venture capital firms are very expensive places to raise capital. And so these companies, if they were able to access the public markets or a more scalable, efficient version of the private market, would have a much reduced cost of capital. And one of the things that was actually, it came up in, one of the gentlemen was speaking on the main stage earlier today, talking about one of the biggest mistakes that they've made is they sold a portfolio company too early. And in a couple of different conferences I've been to, this is a particularly painful problem amongst European growth companies, because as bad as that capital markets no man's land is in the US, it seems like perhaps it is even worse here. And the result of that is if you get to a $300 or $400 million valuation, that's a home run. And if the idea is the distance between that $300 million valuation you're at today and where you might want to get to in order to get to a public or an IPO at a $1 billion valuation, maybe that looks like another 3 or 4 or 5 years, and maybe the sources of capital or investment is not available to you, and maybe you think there's no way for me to be able to take any money off the table. So a $300 million exit today looks a lot better than a very difficult path and an under-supported path from a capital markets perspective to that $1 billion valuation, and so you sell too early. What do I mean by too early? Again, it's just the notion of having an achievable opportunity, a target that you might have hit, new product, or you conquer new market or attain market leadership to create some positive change for your customers that would drive a step function, a step up in the valuation of your company. But again, you just decide that you don't have the capital market support or the risk is too great given the lack of that support. What do we propose, or what would it mean for us to actually solve the problem that I'm talking about? Well, first, it would be low-cost capital to grow for the companies and then liquidity for the stakeholders. So what we've set out to do with the NASDAQ private market is to create the first truly global capital market for private companies. And we have the benefit, because we are private, that we are exempted from the regulatory, I won't say regulatory oversight, that would be inaccurate, but the regulatory burdens of registered public companies. So companies on the NASDAQ private market won't have to file S1s with the SEC. They won't be subject to Sarbanes-Oxley. They won't be subject to shareholder litigation suits of the kind that you see in the public markets. And because of that, and sort of similar exemptions in other jurisdictions, we can create a single community across Asia, the US, and Europe to connect capital with individual investors. And we can use that platform as a way for maybe a $300 million market cap company that no one in Silicon Valley has ever heard of to become aware of a great investment opportunity and do it in a way that is compliant. And that's always been, kind of the challenge in the private world has been the securities regulations that prohibit companies from, quote, advertising or generally soliciting investors for opportunities to purchase shares or invest in the company. And that's part of the problem that we're looking to solve. The efficiency in the financing process, what we're talking about there is that my background is, I started as a securities lawyer at one of the Silicon Valley law firms called Wilson Sonsini. And you think of the cost of raising capital just from a processing point of view in the private world is something like 10x what it might be in the public world, right? So just doing some fairly simple things like automating transactions, standardizing contracts, putting these things online can create an enormous difference when you consider the way that it's done today is with lawyers charging, whatever, $700, $800 an hour to do the same sorts of things over and over again, recreating the wheel. In terms of liquidity, what would it mean to solve the problem that we're talking about from a shareholder's perspective and from the company's perspective in providing their employees and early investors with liquidity? And it all comes down to control. And I think people talk a lot about call it the first chapter in the evolution of these new marketplaces, how little company control there was and how active the market became despite no real opt-in or participation from the companies themselves. And so what the NASDAQ private market will be is quite different. And we can talk a little bit about the kind of the product and features and solution set that we're giving companies. But what they need to, it all goes to their ability to control, one, what level of financial information do they disclose and to whom and when? What is the price at which the shares trade? When do they trade? How many shares trade? And at the end of the day, if the company says, for whatever reason, I don't want any trades to happen at all, we need to be able to enable that too. Because the point of this is not to create basically a private market version of all the problems that exist in the public market, right? Rather, what we're shooting for, what we're aiming for is to try and give a private company the ability to eat its cake and have its cake and eat it too, right? Which is to remain private, to maintain control over who's an investor in the company and how much information you disclose and to whom, but and still have access to a large, robust capital market, but be able to choose who you engage with and screen out those you don't want to. So that's why we created the NASDAQ private market. And so there's everything that we do in the NASDAQ private market now falls into kind of two large buckets of functionality in order to create the solution that I've been trying to describe here. So one is a capital market, and we talk about how we deliver that. And the second is a set of tools to create efficiencies and connections between company and that capital that we've assembled. So this is on the solution set and the tool side, or the tool side of things. What we wanted to do was create a seamless end-to-end solution from when that first shareholder or the company thought about creating liquidity or raising capital through each of the steps all the way through to settlement and beyond. So most obviously and perhaps most importantly, finding the investor, finding the other side of the trade. And from there, documenting the trade and executing it, then escrow and settlement, then transfer agent, then updating the cap table, and then updating the stock plan administration systems. And so right now, almost all of those steps are managed by companies either through some patchwork of different vendors, or frequently and strangely, we've talked to a number of certainly multi-$100-million and even some billion-dollar market cap companies that are still keeping their cap tables on spreadsheets. And you can imagine, and actually this is the case, I am told, Facebook, 6 months before their IPO, they still kept their cap table on a spreadsheet. And you can imagine with the frequency of trading happen and how large the company is becoming, the number of option grants, the number of employees that live in different countries around the world, how important it is, particularly if you start to see secondary transactions happening, that you have the similar sorts of infrastructure to what a public company might have to manage all of that activity and avoid the sorts of errors that come from taking spreadsheet information and moving it through different systems and that lack integration. In terms of the capital market piece and the sort of the market structure that we're looking to, or will be bringing to market shortly, we have a multi-broker dealer system. So think of perhaps if you're familiar with Instinet or some of these other sort of earlier versions of this, it's a hub and spoke model. So the NASDAQ private market is a US broker-dealer and an SEC registered alternative trading system that sits in the middle, but doesn't represent any of the individual buyers and sellers on the platform in a broker-dealer relationship. Rather, in a sense, the true customers of the NASDAQ private market are our broker-dealer partners. And so we'll launch with somewhere between 10 to 15 broker-dealers on the platform, some very large, some mid-sized, some boutiques, that will each bring their customers to the platform and represent them in transactions. Not sure if this is the best slide, but just in case I don't have a later slide, let me just talk about what that private company portal is that sits in the middle. So as we talked about before, I talked about before, we wanted to give the private company the ability to preserve the benefits of being private. So control over its financial information and control over who can transact. And so think of it as each company that engages with the platform creates a closed network, a private network within the larger platform, which we very creatively described here with a padlock. Very ingenious. And what that means is even if sort of the number of investors that we're talking about on the platform at day one, just from the SharesPost community, is about 40,000 accredited investors and qualified institutional buyers, they can all see that a company, oh, almost went off the stage, that a company is on the platform, but in order to engage, to see any financial information or obviously transact, they need to register not with the platform, but with that individual company, filling out a profile that describes who they are, what they propose to do. And what we're trying to do there is take online much of that same activity that has always occurred in the private market offline. So the same sorts of questions that a CFO might ask when being introduced to a prospective investor might be, well, how big is the fund? Where are they based? What are the other things that they own? Those sorts of questions get filled in. Think of it like a LinkedIn sort of profile or a LinkedIn profile for someone looking for a job. Think of that as the kind of resume of an investor that a company gets to see before deciding whether or not to give them access. And because we have this large number of broker-dealers and their clients, the company has the ability to go out into that marketplace and invite investors back to the portal. And then that portal becomes not just a secure place to control the company's information and how it shares and what it shares, but it becomes like a CRM system for that private company's communication with the world of possible investors in that company. And so it allows, and it's persistent, right? So it's not like just a data room where you do a deal, you raise money in a financing, and then you say goodbye to those investors, or you don't say goodbye, but you don't talk to them that often unless perhaps they're sitting on your board, and you go build the company for 18 months, and then you say, okay, it's time to go raise money again, and you restart the private placement process from scratch, and then it takes you 6 painful months of traveling around and talking to people. What we're proposing is that you set this portal up once, and it becomes like your continuing CRM system, platform, investor relations platform, to keep the world of investors, even if you've not taken money from them, informed to the extent you want to about your progress as a company. So that then when you're ready to go raise the next round, right, it's not a cold start. Rather, you've preserved these relationships. You have a compliant, secure way to say, okay, we're now soliciting interest in the next round of financing. And there's a number of ways that you can then price that next round. But we think of it as a significant benefit that you can build relationships over time and build credibility with a large investor population without being public, without that burden, but still having all the benefits of being private. So if I'm going to just kind of rattle off the benefits that we see for private companies. So one, you continue to control your cap table. So you can consolidate, in fact, your shareholder base. And so this is something that we did in the very early days of kind of prototyping this product with LinkedIn. As they approached their IPO, they were concerned about the number of shareholders. And so what we did for them is we flipped a switch within the portal, or the precursor to the portal, that said only existing LinkedIn shareholders can be buyers at the time on SharesPost. And so what that meant is every transaction that happened on the platform actually shrunk the shareholder base and consolidated those shares in the hands of longer-term, deeper-pocketed institutional investors. And they found that very helpful. You provide liquidity to key stakeholders. The ability to recruit and retain employees is sort of a critical benefit of our platform. And maybe this is sort of more of a Silicon Valley sort of thing, but more and more what we hear, though we're biased and we're looking for stories like this, of course, but employees coming into private growth companies in job interview situation, and they'll say, yes, I want to know about your 401k plan. I want to know whether you've got dental and what your medical plan is, but I also want to know what's your liquidity plan. You know, how often I'm going to be able to sell these shares and when. And I think that the more forward-looking companies that emphasize a culture of ownership and want to make those equity incentives real will be engaging in liquidity programs on our platforms or otherwise, or on other platforms. One of the other benefits and use cases that seems to resonate with a number of certainly even later stage issuers is the notion of using the NPM as an on-ramp to an IPO. So what I mean by that is, well, a number of things. So one of the things is to take those software solutions around cap table and stock plan administration and starting to put them in place, use this platform to put those in place today, rather than waiting for that 3, 4, 5 months before the IPO when it's a mad dash and the CFO is, you know, his house is on fire because he's got so many things to do to get in place, you know, on top of drafting the registration statement. You know, start to put those kind of public company systems in place now so that you can use them, benefit from them, and you don't have to put them in place at the eve of the IPO. Also, that investor relations tool set that I was talking about becomes particularly important for a company contemplating an IPO. Because I think in a number of companies, Box has been one, stories have been written about it, and OpenTable is one of the first ones that I had heard about this strategy. But essentially, even though they knew they were not going to be going public for, say, 18 months, 24 months, they started to behave somewhat like a public company with relationship, or in relation to the marquee mutual fund complexes, or the 25 to 35 or so premier U.S. institutions that, at least for a U.S. company, are the critical anchor tenants you need for a successful IPO. The long-only, deep-pocketed funds, the Fidelities and T. Rowe's and Wellingtons and such. And instead of waiting until the eve of the IPO, when they do a roadshow sort of sprint with their underwriters, where it's 20 minutes here, 40 minutes there, and then you're on the plane to the next city, they had been building credibility with those investors over a much longer time frame. And those investors had seen the company perform over time and understood what the company was looking to accomplish. And so the mission of the company. And so the theory goes that an investor who understands the story and has a relationship with management, if there should be a hiccup in earnings after the IPO, they're much less likely to abandon the stock because they have a much better understanding of it. Safeguards. These are mostly about compliance. Secondary transactions are happening in many of these companies, irrespective of whether the company takes takes their company to a platform. And what tends to happen is you can have on the same day 4 different secondary transactions might be coming together. But because they're not connected, there's no platform, right? They could be happening at 4 different prices with varying levels of financial disclosure, or in some cases no financial disclosure, all on a different set of purchase documents. And so it creates sort of the worst possible world of potential liability for the company, shareholders that get an unfair price, and just from an efficiency point of view, a real headache for the GC or the CFO to try and process these transactions, all of which are on different forms. So what we propose is the way to save time and money is to digitize a private company's stock or back office or equity management program so that all of these things occur in one place, online, standardized documents, backed up in the cloud, documents archived in the cloud, as compared to the traditional process that you see today around sort of lawyer-driven settlement process. This, I guess I will skip because I've kind of talked about the benefits. I guess one of the points maybe that this slide makes is that unlike the public markets where maybe it's unfair to say, but there's sort of a one-size-fits-all, product set or solution set for companies in that market. We recognize that there is a natural life cycle for companies in our marketplace, and so the things that we do for them when they're 5 years from an IPO are very different than what we do to support them in their run-up to an IPO. And we also see an increasing number of what we are calling the permanently private companies. They're a $300 or $400 million market cap company, very successful, but they recognize that either because of their growth rate or just the size of their addressable market or maybe just the preference of the founder, they have no ability or intention to ever go public, yet they still want to avail themselves of low-cost access to capital and equity incentive program so that they can recruit and retain the best employees. So I can get into appendixes, but I'll do that probably just in a kind of a Q&A way. Let me just given the hour, I would sort of turn it over to questions. I know it's kind of the speed round, but I'm guessing it might be more interesting if we pick up questions. Sure.
Wait for a mic, I think.
I don't know if the mic might be downstairs at the bar, I think. Is
Would this always be envisaged to be professional investors rather than retail investors?
Sure. So yeah, and it's sort of a moving target of a question because the market is changing. So certainly it was the case at SharesPost when this market was just getting started that there was a predominance of smaller selling shareholders and retail investors that we were connecting in kind of Craigslist-like fashion. And so the average transaction size at for the first, 6 months, 3 months, was something like $50,000 or $60,000. And it was almost as if people were just sort of dipping a toe, just can I even get a transaction done here? But then as the institutional world started to see those, yes, in fact, transactions were getting done and large amounts, they started to participate. And so I haven't looked at it in a long time, but I think at SharesPost, the average transaction size now is somewhere around $750,000 per transaction, and it's a pretty, the distribution curve is pretty flat. So we have $10 to $15 million transactions that happen at SharesPost today. There's very few $50,000 transactions, so it's probably, again, I don't know, somewhere between $750,000 and $1 million. And the NASDAQ private market, importantly, is taking sort of a different approach than SharesPost. So in most cases, or it's probably not interesting to go into the details, but in most cases, the true retail investor, the sort of unaccredited investor, has never been able to participate because of the securities laws. Only accredited investors could be active on the platform. But because we're giving companies now the control, I think many of those companies are going to say, we don't want true mom and pop, even if they're accredited investors. We want more of an institutional focus. And so that's certainly how we're building the platform. And there are, I think, alternative ways for the accredited investor to get exposure to these companies that doesn't involve sort of single rifle shot sort of investments. And so they're being aggregated and being offered kind of new fund type products or special purpose vehicles or other sorts of solutions. But I don't think you'll see retail investors able to, or in most cases, purchase shares in the companies on the platform go forward.
Okay. I did have sorry, I was going to say there wasn't enough question. I had a follow-up, which was was around the secondary market. So how important is it to institutions that are buying on this exchange that they have a third party to sell to in the event that they want to, and as they would with on a true NASDAQ listing?
Sure, sure. So I think for the most part, the institutions that are buying on the platform are looking ultimately to exit their stake in the public market. So it's the predominant use case for a larger institution would be, I'm going to put maybe an initial $10 million to work in a company that may be 24 months out from some kind of liquidity event, and maybe I'll increase that position over time, but ultimately I'm hoping for kind of a classic kind of venture or late stage fund kind of exit. There certainly have been cases, though, and Facebook was an example because there was so much liquidity in our marketplace in Facebook that we did start to see people who bought, I mean, the first shares on SharesPost, I think the first Facebook transaction was at $2 a share, pre the 10-to-1 split. And so people who had made a large sum of money then, even pre-IPO, resold those shares. And so I think that's kind of a unique case, though. I mean, certainly not, it's not a place for day traders. It's not a place for anything but very long-term focused investors.
Thank you.
I guess you got to go with the mic, yes.
A few questions. Forgive me if I missed the first minute or so, so forgive me if you answered any of these. What are the criteria for companies to join?
So there's a membership requirements, and actually I think that might be something we have here. Hold on. No, hold on. It'd be really embarrassing if we don't have it now. No, we don't have it.
We had some growth metrics,
sure.
etc.
Yeah. So we've kind of borrowed the approach that NASDAQ takes in the public market. So there are multiple sort of alternative tests, any one of which a company can meet and then be entitled to membership on the platform. And so it's a $50 million valuation in the recent financing. It's backing by a known venture capitalist. It's, I think it's $750,000 in net income, and I think there's a fourth one, but I forget what it is. But I mean, so it's meant not to just create the bar at the kind of level of Twitter, Facebook, and LinkedIn. It's meant to create a bar where really growth companies can come onto the platform and benefit from it. But even outside of those membership standards, we do want to make the software solutions, the cap table management and all the other tools that we've talked about, available to all companies, irrespective of whether they meet those requirements. The difference is, if they don't meet the requirements, they can't use the platform to raise capital.
And just going back to the question the gentleman in front of me asked before, what is the exact current situation? You kind of mentioned an evolving situation on membership for investors. Mm-hmm. What is the current criteria?
So to be on the platform, or to view investment opportunities on the platform, you need right now, today, which is the platform is operating under the SharesPost brand until we launch as the NPM, which will be sometime in the next couple of months. You need only be an accredited investor. What we're looking at in the NASDAQ private market world is a significant kind of raising of the bar of the sorts of investors that can participate. But even today in the SharesPost world, companies can still screen out retail investors if they choose to.
So when you say accredited, you mean under U.S. regulation or? Under
U.S. Reg D, yeah. So that's $1 million in net worth, excluding your principal residence, or you can meet it on an income standard as well.
Okay. And the other question was just about the sort of launch process and what's not available now that will be available when you relaunch in a few months.
Well, so many of the tools that we're talking about now are not available on the SharesPost platform. So since we signed the deal with NASDAQ, and even actually before, for 3 or 4 months before, we've been sort of busily working like elves in Santa's shop to kind of build this next version of the website. And so we're quite excited to be, coming up on the big, grand unveiling right now.
Hi. Could you provide some figures about what are the company involved, the turnover, the liquidity of the market, the amount of transaction in SharesPost, and then what you expect from the new platform?
Sure. So just on the SharesPost side, again, I'm not as, my day job is now at the NPM, so I'm not nearly as close as I was to the data. I can say, I guess I can say a couple things. So in the first 18 months from when SharesPost got its broker-dealer, it did about $1.2 billion worth of transactions and secondary transactions on the platform. That was in about 60-odd companies. What has been particularly interesting is, certainly a very a significant percentage of those were in a handful of companies, Facebook, LinkedIn, et cetera. After the Facebook IPO, there was certainly a substantial reduction in activity in that marketplace. But since, call it Q4 of maybe 2012, we've started to see that activity ramp back up again. And so there's now actually more transactions happening and more volume on the platform at SharesPost than there was during the Facebook time. And what is encouraging, I think, for the sort of the health of this new capital market is it's not nearly as concentrated. There's no company that probably represents more than 10% of the total transactions at any given time. In terms of what we expect at the NPM, it's hard to know. I can't help but think that the addition of the NASDAQ brand, the trust that implies to players in the financial markets will bring investors that otherwise wouldn't have participated on a SharesPost branded platform that will in the NASDAQ world. And the work that we've done and NASDAQ has done with us to bring in other broker-dealers of size to bring their clients to the platform so that one of the challenges, of course, at SharesPost was I could go to, a SharesPost broker or a customer could come to SharesPost and contemplate a transaction in a quality company. But what they would want to do is talk to their banker at Morgan Stanley and say, is this a good idea? Is this, how should I think about this? And that wasn't possible. They could only talk to a stranger at SharesPost, not nearly as likely that they would transact. Now, well, I'm not saying Morgan Stanley is on the platform, but to the extent Morgan Stanley does come on the platform, and we hope eventually they will, I think you'll see a significant increase in the volume of transactions. And the other piece that makes me think that that's the case is the way private companies respond to the NASDAQ brand. It's so consistent with how they look at that, the IPO marketplace and what it means to have, a trusted brand, a marketplace with integrity, with rules, compliance, et cetera. Already just in the companies that we've been talking to, we see a significant, or a significantly greater degree of receptiveness to the idea of turning on one of these private company portals. So we think if you have the companies engaging and you have them disclosing financial information and you have a much broader network of investors working with brokers that they already know and have a relationship with, it makes sense to us that that should create, even a more significant ramp from where we are today.
Yes, you said there is a standardized way that the company uses in order to report information. Is there some minimum requirements in respect to what the company have to disclose to the investors before the investment is made and after the investment is made?
Yes, a good question. So what we were trying to do in coming up with those disclosure or requirements was kind of balance the need of the company to keep its private information private, and yet the sort of investor protection concerns, of course, of adequate disclosure. And so where we landed on that was companies raising capital over the platform would need to disclose 2 years trailing audited summary financials. all of which the companies on our platform, or I shouldn't say all, almost all of which the companies wanting to be on the platform already have. But we do not require forward-looking statements, which is, for a company in hypergrowth, is a very important obligation that would be a very onerous obligation to put on them. And then maybe most importantly, that financial disclosure only needs to be made to the actual parties transacting. Right, so you don't, even within the participants in your portal, you don't need to disclose financial information to them unless they're transacting. And there is a continuing obligation. Once they have transacted, you do need to provide that level of information to them on a go-forward basis as well. All right. So I think someone, I don't know how the prize worked for the 7 million euros, but I think I'd love to find out who won. So maybe we wrap up there, call it a day. Thank you for staying late with me and with us. I appreciate it. Thanks.